Hi everyone, welcome to the weekly stock market update. I'm hoping this works rather well for us because it's a slightly new format that I'm using to go live. You can see me up here. Here I am. If you wanted to see a full overview of me, I'm sure there's a way to. There you go, that's me. So in this weekly update, just a reminder, it's not personal investment advice. The markets can fall as well as fall even more. So be cautious about that, but I'm going to give you the market update as we go on, and just let me know you can see and hear me. So as I said, here we go, and it should all work out rather well. Okay, it's all part of my campaign for 1 million to teach 1 million people how to invest better, and the links for all of that are over there. I've just posted that, so have a look at that. So as already mentioned, it is not personal financial advice. Okay, I want you to know that. And that's because I don't know you individually. It's also not a solicitation to buy or sell any specific stocks. And the other thing to remember is I've been busy writing that book. I've been out in Bali writing my book commissioned by the Financial Times on investing. Just let me know. You can all see and hear me loud and clear. So there we go. That's Microsoft, by the way. These are valuations. What's happening on the market valuations at the moment? Let me tell you exactly what's happening on market valuations at the moment. What we're seeing is you're paying $33 for every dollar of future profit in NVIDIA, for instance. You might say, well, that's awfully expensive, Alpesh. Surely you just want to buy JP Morgan, which you're only paying $12 for every expected dollar of future profits. Well, valuation, as measured by price to forecasted earnings, is not the only measure of what moves stock prices. What also moves stock prices, as I've often said, is of course things like revenue growth. Okay, so that's why we don't just look at stock price valuations, we look at growth as well. Now, the only thing out of the earnings calendar, that might be a bit difficult to see there. What I want to point out to you, the only thing which is worth looking at is going to be the NVIDIA results. Okay, everything else a little bit irrelevant. Okay, don't forget to like, comment, share, and subscribe. Now, one of the reasons why I look at not just valuation is because if you look at less information on anything, then what you're actually doing is you're gambling. Okay, when you decide that I am not going to look at specific pieces of information, that means you have chosen to gamble, and I don't like gambling. That is why for stocks, I go through 10,000 companies to look for the ones which are undervalued, revenue growth, dividend yielding. Sortino and alpha is important. Momentum's important as well. Probably the most important on there is what I call the Alpesh value growth income algorithm, which measures valuation as being more important because the academic research shows it to be the case. Okay. I've never heard of Gary Stevenson. Sorry, I don't know who he is. I've spoken to 10 of the world's leading traders. So for my book, Mind of a Trader. So I like those professional hedge fund managers, my colleagues who are far better than I am. People like Sir David Harding. There's a great trader. David Kite. There's an incredible trader. Okay. No thanks. No thanks, Sam. I'm good. So Sortino, alpha, value, growth, income, cash flow, and all of those. Okay. We want to look at all of those factors. I'll come back to NVIDIA in a second. If it's falling after earnings, probably people are taking profits. Come on, since January 2023, it's gone up so much. Why wouldn't you take some profits? Now, and people are looking for excuses to take profits. This has been the market over the past week. So that's the last week with what's been happening. Whoops, there you go, past week. And you can see there's a lot of green, and that's my job, is first of all to make sure we can take advantage of opportunities where there is a lot of green, but also separate to that, I would say, let me just move myself out of the way as much as possible, as well as that is not be spooked by any given week, because it's an investment, and if it's an investment in my pension, then I really want to be looking at a 12-month period. And over the past year, you can see there's been a hell of a lot of green. And that's far more important for me, that there's been a heck of a lot of greens up there over the past year. And that makes it a hell of a lot easier to make money. It's a lot easier to make money if you're in a position to take advantage of opportunities where there's a lot of opportunities. I didn't make these companies, I didn't invent them. Than if you're trying to guess things on a week-by-week basis. So over the past year, a hell of a lot of green. I'm more than happy that I continue having Microsoft, Apple, Amazon, Alphabet, Nvidia in my portfolio amongst a few others, Coca-Cola, Goldman Sachs, JP Morgan. Okay, rather than thinking about them week to week to week. Okay, looking at ETFs, I won't talk about exchange traded funds in this particular broadcast, but you can investigate them yourself in your own good time. Feel free to have a look at exchange traded funds if they suit you. Now, very important lesson to teach people over how prices move. You can see the S&P is up 17%. Hopefully your pension, your savings year to date are up 17%. But notice how there were prolonged periods of 0% return from February until August. You had a 0% return on the NASDAQ from February to August. Yet that's in a year to date where you've had 16%. Okay? The markets do four things. Either, of course, they rise, like they did the start of the year, as they did from May. They fall, obviously, is their alternative, as they did in August. Or, and that's bad, of course, or they go 0% for a long period of time, or they rise then fall, as they've done in January all the way back down to May. Three of those things, therefore, don't give you good returns. 0%, or they rise then fall back, or they fall. They don't give you any returns. Only one of them does when they rise. We're not trying to time it, as traders would, to find the ones and ignore the 2s, 3s, and 4s. What we're saying is, if we're investors, we know 2, 3s, and 4s are going to come. We'll be patient, because the ones will give us the 16% year to date. Now, that's incredibly important to understand. If you don't understand that about investing, you've got a problem. These are the sectors which have done the best. I don't gamble on individual sectors, as anybody who follows me will know. Okay, so you will see on there, I'm just going to put a link for some of the free stuff that I've got. If you want to find out more on the LinkedIn channel, or my YouTube channel, and so on. Okay. So where does that bring us? Well, I didn't make a gamble at the start of the year on utilities doing better, and communications or financials, or technology or whatever else, or healthcare. What I did instead is look at individual companies. So I looked what's called bottom up, not top down. Okay. And these are the factors which go into stocks. So you can see there's all of those sectors that have done well have only done well because of three factors: either momentum, value, or growth. Well, guess what? Momentum, value, growth are all three things that I need ticked before I'll buy any stock. I won't just say, oh, I'll only have growth stocks, I'll only have value stocks, I'll only have momentum stocks. I need all three boxes ticked. And I don't mind how many good companies I throw out, as long as the companies that are left are good enough to be in my portfolio. Got it? And that's a common mistake people make. They try for perfection. They try to find the holy grail of investing and say, oh, well, anything that I do must always be good companies. No, I don't mind throwing out a lot of good companies, as long as what's left are good enough to be in my portfolio. And even those aren't guaranteed to go up. So I need them to tick the value box, the growth, the income, like dividend yields, and momentum boxes. Why? Because it means I must then be having lots of quality filters in my pension. And I must, therefore, have looked at as much information as possible. If you don't have lots of filters and don't look at all the information, then you're speculating and gambling, which is why people often mistake investing with speculating and gambling. So over the 12 months, even if, let's say, I did as poorly as just mimic the NASDAQ, then fine, my pension's up 31% in a year, or the S&P. But remember what I said earlier about four things prices can do: 1, 2, 3, and 4. One is when they rise, which is only 25% of the time. 2 is when they rise, then all the gains go again, right? So you feel a bit dejected. 3 is when they give you 0% over long periods of time, like from February until August. And 4 is when they fall. So if 2, 3, and 4 happen, which is 75% of the time, you're pretty miserable. Even though 25% of the time, they rose and gave you a 31% return. Do you see why investors therefore constantly get wrong-footed, exit the market, and don't have the patience to stay in? Because every time they get a prolonged period of 0% returns or falls, or their gains get whittled away, they think to themselves, oh, that's it, it's all over. Whereas, as Warren Buffett says, the stock market is a way of moving money from the impatient to the patient. The impatient are the ones who, when 2, 3, and 4 happen, people panic, and it gives us money. Who are the patient ones. It's as simple as that. Okay, so that's what we have over there on that. Now, which were the biggest rises over the past month? Well, St. James's Place, partly because they've fallen so far, they're just dead cat bounce. You can see some of these on the FTSE 350. Going to the S&P 500, it's pretty much at all-time highs, but the momentum is getting more and more overbought. September tends to be the worst month. Look at that. Okay, September tends to be the worst month for the S&P 500, but it is at all-time highs. You're welcome. I didn't do that. I didn't create that. That is not why my pension and other people's pensions are doing well. It is because the companies within it have been doing well. Okay, and because it's overbought, it's a little bit like it was back here. Look at that there. It's like it was back here around this period at the back end of 2021 before a big fall. I'm not saying that big fall is going to happen. We don't have enough data for that. So all those people who like to forecast, oh, we're on the brink of another collapse, like a broken clock, they're right twice a year. Okay, so that's where we are. We do not know yet if there's going to be a fall like in 2022. We do not know that because we do not have time machines and the future is not written. Similarly with the NASDAQ, near all-time highs. I wouldn't be buying the NASDAQ right now. I continue holding my S&P 500 and my NASDAQ index trackers, but I wouldn't be buying more right now because it is a bit overbought and looks a bit like it was in 2021. So what's the point of getting in with little upside and greater likelihood of falls? So I can't see how it continues going up. It could, but I just don't see how that continues happening. Doesn't mean there's a crash. It's not binary. Okay, FTSE 100 chugging along, I guess. The top 10 S&P 500 stocks over the past month have been these companies. Okay, these companies. Well, ResMed and Fortinet are two of ours. PayPal is as well. So let's have a look at these, some of these, and see if they are worth our time, energy, and effort. All right. Remember, markets can fall and fall even further. So Kellanova is not one of mine. It's not one that I've picked. Whilst on a value growth income basis, it's an 8. So 7, 8, 9. Remember, it's my proprietary algorithm, which looks at the valuation of companies' revenue growth, dividend yields, weighs valuation more than growth, because we know from the academic literature value is more important as a factor for future stock price moves than growth, which is more important than dividend yields. So whilst that's an 8 and the momentum is rising, I'm just worried it's had such a big move up. And it's a relatively unknown company, so, not really for me. Fortinet, 7, now near highs all time. Momentum should break through from that oversold position. Should, not guaranteed to. It's often got up to this level and fallen back. And if you already held it and you didn't like those drawdowns that it's had historically, then don't buy it again. Remember, drawdown depth and duration to recovery is how you work out your risk appetite. If you didn't like what it did historically, then don't think it's changed its spots and it won't do it again and won't have the same drawdowns. In which case, leave it well alone. Don't go into that company. Starbucks, of course, change of CEO. Again, value growth income 8. I'd rather see a bit more move to the upside till the MACD has moved above its signal line before personally looking at it as a purchase. So a bit too speculative for me at the moment. Not enough momentum on that one. ResMed is one that we've got, and it's an 8. Great. And just waiting for it to chug along. Waiting. The market, a lot of it is just waiting, and that's one of them. PayPal was disastrous historically. I mean, you can see the falls. And I think it's burnt a lot of people. And whilst it's having this breakout, I think a lot of people will be cautious of the value growth income. They'll be cautious of the fact that it historically had fallen so much. And they'll say, you know what? If they're risk averse, they'll say, I'm staying out of it. Vistra Energy, 7, 8, or 9. So it ticks the value growth income box. But momentum, too overbought. Doesn't mean it can't keep going up. All these analysts and bankers seem to like it, and seasonality-wise seems good, but not one for me because I tend not to like companies which are overbought on momentum. What does overbought mean? Well, if you look at this box here from top to bottom is if it's in the top quarter, which is a measure of the short term and the medium term stock prices. And if the average prices are both rising, and they have been for a while, there tends to be a bit of a pullback, a reversion to mean. Things can't keep going up exponentially. And that's what I mean by overbought. And therefore, I tend not to like to get in after such big pulls, because pullbacks do happen, as we know, in the hedge fund industry. Eli Lilly, generally a good company because year-on-year exceptional gains, all-time highs, all of those boxes tick. But again, overbought, so not for me. But, if you said, listen, I want it, then be my guest. But again, not one for me as things stand at the moment. What about Nike as a stock? Well, whilst it's had some big sharp rises, I guess because it's at multi-year lows, still more broadly a downward trend, a bit too risky for me, I'm afraid. Doesn't hit my value growth income, which Howmet Aerospace does. It's been going great guns, and if you got in earlier, you'd stay in, but you wouldn't get in today because it's overbought. But if you got in before, you'd stay in, and if it drops X%, you would sell Y, and that's perfectly fine. Okay, Kenvue, one of those big sharp rises, not enough data for me on that one. 789, fine. But I can't see what the momentum numbers are like. And sure, some people say it's going to go from these levels to its all-time highs. Too speculative for me. Costco, a company that I do like. I like to be in for many years, and then there are periods when you're out. And at the moment, it's overbought, so I wouldn't buy more now. But if you're already holding it and you've got that gains of past years, you can see those phenomenal gains. What a lovely one to have in a SIP or ISA. Apple, I continue holding, not looking to buy more immediately. Amazon, I continue holding, not looking to buy more. Microsoft, I continue holding, not looking to buy more because, again, with all of them, a bit overbought. Meta, I got out in April only because I need to rebalance the portfolio from January 2023 because there'll be massive gains in this and the other tech companies. Netflix, not one I own, as you all know, but I've been following for people since they had those stellar returns, about a year ago, and it's been going up. And you might say, well, you missed one. It's fine. I had Meta and Apple, Amazon, Alphabet, Nvidia, so I don't mind missing the odd one. Not one I'd get into at the moment, even though it's got an 8, because as you can see in the past, when the average prices have been this high, it's tended to either go sideways or fall. So not one for me at the moment. Walmart, all-time highs. Great one for your pension, generally, historically. It's got an 8 on my value growth income metric. However, overbought, as you can see over there. So not one for me at the moment in this market, though seasonality-wise and what the analysts think, all incredibly positive. I invested in Nvidia since January 2023, when I thought the numbers looked good, value growth, income, cash flow, and I thought it was because they were making crypto graphics cards. Of course, they were doing AI, which I didn't know. But value growth, income. You can see on my Telegram channel purchases and sales. I didn't know Nvidia was going to do so well since then. If I did, I would have put everything on it, but I didn't. So there you go. I wouldn't buy more today, though. Berkshire, because it's overbought. Berkshire Hathaway, all-time highs, but a little bit overbought, which worries me. It doesn't mean it can't keep going up and up and up, but I tend not to buy things when they're overbought. Eli Lilly, I've mentioned already, haven't I? Walt Disney fell. Those companies with drawdown depth like these, and they're volatile, you might not want to. Great brand name, but then again, so is PayPal, and yet this is at multi-year lows, and it's a wait-and-see game with that. As with CVS, great brand name, multi-year lows, looks cheap, dead cheap if you look at the price-earnings ratio. Same with Walt Disney. At some point, they should spark up. CVS, again, waiting game with those. Have a look at the LinkedIn. You'll see more of my articles and columns. I'm going to see if I can blow my screen up a bit for you, because you don't need to look at other stuff now. So have a look at that. I'm a top voice on LinkedIn. If you don't know what that is, Bill Gates is a top voice as well on LinkedIn, so feel free to have a look at my LinkedIn. If you don't know where my LinkedIn is, and you can follow me on there, where I talk and write about stocks and investing. And you'll see some of my background as well. I'm ex-Bloomberg TV, set up a hedge fund in 2004, so asset management CEO, Financial Times columnist, BBC paper reviewer, and all of those things as well. And you can, yeah, I'm blocking out Bill Gates, I know. Thoughts? I haven't looked at Nvidia's earnings at the moment. I continue holding the stock at the moment, but I've not had a look about their figures. I don't particularly care, because when I hold something, my exit rules are 12 months, or if they keep rising, then in the case of this, if it becomes a daddy bear, basically if the monthly MACD moves below its signal line, then I'll exit. Beyond that, I don't really care what their earnings say. CrowdStrike's irrelevant for market movements, as you can imagine, because it's just not in the public conscience. Thoughts on rate cut pricing of so far, still pricing it in. It is my area. I've got a master's degree in economics, so I hope interest rate changes are my area. They better be, otherwise my old economics tutor is going to be very disappointed. What I would say is about those interest rate cuts is it's fueling the market rises. There'll come a point where the market has to, as I've shown you today, drop off a bit. Thoughts on Boohoo shares? I don't know. I've not had a look at them. Okay, so sorry about that. So don't have a view on the Boohoo shares at all. But like I said, the easiest way I've found historically, in order and simplest way, I've written about it in my many books and in my Financial Times columns and all the rest of it, to determine which way the markets are going to go. The big indices, the S&P 500, it's very simple, and if you've done it over the last few years, you do rather well. Is just look at the monthly moving average, convergence, divergence, the MACD on that. And if it falls from a great height, like it did in 2022, below its signal line, then it's time to hold cash. How long do you think until the next daddy bear? Well, if you were to say it's like 2021, where we are now, same time, August 2021, then 4 months. But I don't know. Missed what happened with Nvidia. I don't know. I've not looked at Nvidia today. How do you determine value score when looking for value growth income? So the value score is really based upon academic research, which I've mentioned on my free information. If you look at the free information that I give, I'll put the links up now on there. And essentially, it's based on the research done by academics over the past 100 odd years on profitability, sales, book value, so those against share price. So on one side, you're looking at share price, what you're actually paying for a stock, okay? But to determine valuation, you need some other metric of return that the company's producing. It might be, so share price on one side, it could be the profits the company generates, it could be the sales, it could be the book value. In other words, what if you had to do a fire sale of the company, which is the preferred option of Warren Buffett? It could be discount cash flow, it could be free cash flow. There's all sorts of other metrics. And the preferred one, and by the way, earnings could be historic, they could be forecast, they could be rolling 12 months, it could be an average of 24 months, so it gets really messy. And in my experience, you only really need to look at one of those. And what the academic research shows is that price earnings, and they could be relative price earnings, or absolute PE ratios work pretty good. So that's it. Thank you. I can't believe I've lost weight because I've been eating crisps. Wait to buy the dip or dollar cost average. I don't buy dips. It's not rational. I dollar cost average if I'm slightly cautious into dollar cost average, into companies which meet my criteria of value, growth, income, and so on. Okay, whoops. Let's move this around. There we go. I'll move that. Now, other questions. So, dollar cost average would be, have I missed something? I just got rid of a whole load of questions. Oh, sorry, they're over here. Sorry, I moved something around. I missed it. Joining apprenticeship at SJP in September. The head of economics is a friend of mine. Do say hello to her, but a bit concerned with all you have to say about it. I think you'll be fine as an apprentice. I don't think they're going to go bankrupt. I just think they're going to turn you to the dark side. Alpesh, what's your favourite curry house in Sheffield? Don't go to Sheffield, mate. Do you use current ratio in your valuation? I don't use the current ratio. It's one that I've written about in my books. It's not one that I particularly do. Berkshire added Ultra. Can you do a value for that balance sheet wise? They are strong. Alta. I don't know them. I'll try and have a look at some point. Some of these ratios, they all have a good perspective, but when you look at when you're investing, think of it like a scientific experiment. Have a hypothesis, look at the data, make sure it's been tested. What most people do is just say all things as well. They just, my pleasure, happy to give the free information, they just sort of madly speculate. And that's just nuts. Okay. SMCI shares had a serious drop today. I don't know about that today. I don't tend not to look at, given that I'm looking at a 12-month holiday, I don't tend to look at things day to day. I was out with my son today, most of the day, my wife. Does anyone know what is happening with NVIDIA? Just bucks all trend. With the impending budget, should we be mindful of making a pension decision in advance? I can't comment on that really, because I could say to you, it might be a good time to, as soon as they do the pension, they might say, okay, we're stopping all personal allowances as of midnight today, as they used to do with beer and tax, it's going up, fill your tank is what you mean. I don't think they'll do something as drastic as that, where they'll say, right, fill up your annual allowance, we're cancelling it. Okay, so you should be okay. I've given my thoughts on Seeking Alpha. I think has some clever people on there. I'm pretty sure they tend to be a bit intense. Book recommendations. New Market Wizards is really good. Jack Schwager's book. Mind, The Mind of a Trader. You can download a free copy of my book, Investing Unplugged, completely for free from this link I'm putting on the screen. Jacob, what are your frequent catalysts you see in companies? What are frequent catalysts? Well, as I've often said in all my videos, value, growth, income, cash flow, Sortino, alpha, and momentum. Those are the most important. Thinking 25% tax-free allowance and taking now. Oh, that. I couldn't. It would be irresponsible of me to speculate, Pilastro, on that and say to you, oh yeah, I think you better. I mean, that'd be nuts. I think I'd be fired. I think I'd be prosecuted by the FCA if I did that. I just don't know, and I couldn't possibly give you pension advice like that on the tax-free allowance. Sorry, I don't even know what could happen. What are my early returns on average? They have wild swings, which are highly dependent upon the market tailwind. So I'll give you an example. Last year, when the Nasdaq was up 55%, we did better than that because we had concentration in the best stocks within the Nasdaq. But that's not a typical year. I mean, that's just ridiculous. And similarly in 2021, when the markets were up significantly, we were up about 50 odd bloody percent. I mean, just assume that will never ever happen to me again. Otherwise, my wife would remarry me, I think. But equally, 2022 is 0%. Okay, so it's not the average that matters. It's the massive variance. If we keep getting tailwinds like we had in the last 7 years, 5 years out of 7, we might get some blowout returns. But I always assume we're not. And if we get headwinds and we get those once or twice out of 7 years, like 2022, we'll get a couple of 0% years. Please bear in mind the 0% return years. But it averages out on UK stocks using my value growth income method from since 2004 at 16 to 18% per annum. I think it's closer to 18% per annum. And that's the UK. The US, you know how much better the US does than the UK markets, and there's no point me giving you a number for the US because it's just ridiculous how well the US market does compared to the UK. But for the UK, it's 16 to 18% per annum since 2004. Okay, what were my returns before 2021? 16 to 18%. I say 16 to 18 because I think it was closer to 16.8 or 17.8, something like that. I can't remember the exact number. Since 2004. That's UK stocks, okay, not US. US is, well, ridiculous. But that's not because of me. That's because of Microsoft, Apple, Amazon. And you might turn around and say, well, any idiot could have picked those. Yeah, exactly. I'm an idiot. What's your thoughts on Rolls-Royce? Not had a look recently. How were you able to progress so much in your career? I don't think I have. Really. But then again, I don't know anybody who does think that they have, other than maybe Elon Musk might. Okay, so that's that. What is US return? Well, think of it like this. What's the US compared to the UK since 2004? It's about tenfold more. Wait a minute, the UK went up 40% and the US went up 400%. It's tenfold more. Just look at the NASDAQ, okay, and just assume you got the NASDAQ return since 2004, because anything beyond that is just ridiculous. Do I use discount cash rate? Yeah, as a tiebreaker, but not only as a tiebreaker between stocks, because I think it tends to be too oversensitive to interest rate amounts. If you put in forecast earnings, just even slight growth variances or future interest rate variances change just even a little bit, it has a massive impact. It's very chaotic, in other words. As a system, which age range did you achieve the most progress in your career? Oh, I peaked at 29. That's very easy. I peaked at 29. At 29, I had my own TV show on Bloomberg TV, my own column, the Financial Times. The Prime Minister appointed me on the UK-India Roundtable to advise him on closer bilateral relations. I was a visiting fellow at Corpus Christi College, Oxford. I'd left being a barrister. I hadn't set up the hedge fund yet. And I was being flown around the world by the Foreign Office and by private companies to speak on international politics and economics. 29. Oh, and I'd got my international best-selling book, Trading Online. A friend of mine once said, you've been downhill ever since. Yeah, probably. Any view on Fed rate cut impact on US stock market? Yeah, I've put some data up on my private Telegram channel. Sorry, on my Telegram channel. Telegram's not a good word, is it? Have a look at the links there, and that'll tell you. How would you use I? Do you mean AI? How about competitor analysis, seeing how companies performing against a similar competitor? I look at 10,000 companies, so I do competitor analysis all the time. I'm looking at companies against 10,000 other companies. Okay, that's competitor analysis. Every company is a factory for making money. Therefore, every single company is a competitor of every other single company. Costco is a competitor of Microsoft for my money. That's how you look at it. You don't look at Microsoft and Oracle. You look at Microsoft and every other company out there, because they're all competing to manage your money. Right? That's the right way to look at it. Do I own the S&P? I've got 3 times leverage on the S&P, and I've got the S&P tracker as well, but not tons of money in those, because I've got it in individual stocks as well. What about a US stock that's on the London Stock Exchange Spectra Systems, which has done very well? I've not looked at it recently, so it's not one I can comment off the top of my head. Do you visit these companies like Take Trips? No, because I take the same view as Warren Buffett about company visits. What they're going to tell me, other than that they're amazing, and I can't visit 10,000 companies. So I look at their numbers. Because they're legally obliged in their numbers to tell the truth. They're not obliged to tell me the truth when I walk around with them. What's the board of directors ever going to tell me? Like Warren Buffett said, they're going to tell me how wonderful and brilliant they are. Okay. As well, what amount of money before you can do someone institutional investor? Institutional investor, it's not just, you can have, it's really down to the regulator and the exchange. So if you're a listed fund or you're regulated by a particular entity like Luxembourg, they will determine that number. And that might be as little as $1 million before you can invest. So you don't necessarily have to be an institution, but ideally you only want institutions because they're more sophisticated. So there's a regulatory requirement and there's a requirement of the fund itself. Most funds do not want private investors, even if they're super rich. They don't want ultra high net worths. They'd rather have family offices because they're more structured and they appreciate risk better. And even better than them, because they can write even bigger checks, they want pension funds to invest in their hedge funds. What platforms do you invest through? Well, prime brokerage. Previously, we used to use Bear Stearns. I mean, there's a bloody nightmare for you. But now, if you're talking retail client, you could use anything from Barclays, IG, Interactive Investor, Interactive Brokers. There's a whole bunch. I mean, they're all much of a muchness, I guess. What advice do we give somebody in the early 20s when it comes to investing, managing their time? Enjoy it. I think all the advice that there is about managing time is out there. Read as much as you can. I don't think I've got anything original to say to you other than what you see blurted everywhere. However, what I would say, I'd probably say have a look at the articles that I've written on my LinkedIn on exactly that subject and productivity, because I guess what I've done, rather than tell you one thing now, is to say to you, I've written what I think are the most profound things I found others say. I'm still learning. Okay. I would say learn to speak well, learn to write well. So learn the art of oratory and learn the art of writing well. What trackers, S&P and NASDAQ? Is it worthwhile to get an MBA after becoming a chartered accountant? Too many variables for me to be able to answer that. But all other things being equal, I'd probably say, yeah. Do I trade bonds? No, not since I was about 12, I'm afraid. You're very eloquent in your speech. Thank you very much. How do I tell my SJP fund manager that he's terrible? He's a family friend. Ask ChatGPT. I've been asked this by many people, and they end up with family friends. Often these SJP people put that prompt into ChatGPT, exactly what you've asked there, and it'll give you a really good answer. S&P 500 index tracker funds easy to find. NASDAQ tracker not so easy. QQQ, that's the ticker symbol. So I'm an individual. I really want you to look after my investments. I don't look after individual investments, I'm afraid. Tax on unrealized gains. What? Tax on unrealized? Where do you come from? What ETFs are you using for 3 times leverage on the S&P? I don't want to go into leverage on this because it'd be irresponsible for me to talk about leverage to a broad audience on social media. The reason for that is if you use leverage and something drops 10%, you're down 30%. And that means that it has to then rise nearly 50% for you to break even. Those kind of numbers scare me and they should scare you. So if you need to ask a question about leverage, it means you're gambling, you're taking too much risk, you don't have enough information. So I really don't want to talk about leverage on social media. As I say, I think it's other than to say don't do it. It's irresponsible to do that. Of me, I'm afraid. I've self-invested into shares in ICE 100,000 in tutoring out. Is that a good thing? Yeah, well, if you've got savings, it's good. How do you trust company reports when there are different ways of reporting accounting valuations? I trust them to the level that I can, given that there are different ways of reporting. There is the standardized reporting rules that they have, but sometimes accountants lie. This is true. And you could end up in a company which is Enron, for instance. But that doesn't necessarily mean that everybody does that. So I cross-reference it by balance sheet, cash flow, profit and loss, and I need all those things ticked: value, growth, income, cash return, because that means you might twist how much cash you've got, but you're going to find it very difficult to twist your assets, your cash, your profitability, every single part of that, especially if you're a very big company and there's a lot of other people looking at you. For investing for retirement, what I'd include a lot of money, as much as you can, and probably start off with an index tracker like the S&P 500. I'm thinking tax on unrealized gains. It's real. Oh, I see. My God. The Democrats are thinking about tax on unrealized gains. It's a fundamental principle of tax law, and I did tax law at university as part of my law degree, that you try not... Tax payment requires cash flow coming out. So it's a fundamental principle of tax that you do not end up taxing people in a way where the outflow goes out, but the inflow is not present. Am I too loud? It's my wife. Oh, cool. You can't all see her. Don't worry. Do you need to go behind me?
No, I just need battery power pack.
Oh, battery power pack. It's over there. That's all right. Oh, it's just there.
Okay.
And all the wires are over there.
It's hot in our room.
I'll turn the...
No, don't turn
I'll
it
go
off.
down.
No,
I won't turn it off. I'll turn it down.
don't.
Have you got out of Microsoft leveraging your son's account? Nope. My son's already got it. I've got the window open.
Yes, okay.
Do you want to sit and chit-chat? It's my wife, guys. Might have to leave you all if she wants to sit and chat. What? She's saying no.
Work.
Tell her not to. It's not work. I'm doing a TikTok live. Because you're going to sleep. Oh, really? Okay, guys, my wife's going to chit-chat with me. Sorry, got to go. They're going to hate you. Love you all. I got to go. I don't get time with my wife like this so much. Thanks. The Arga is a pain to run. Okay, thanks, guys. Bye.